Good morning, this is Jim Kegnan with Infinity Futures. Today's topic, 10 Ticks Deep, Introduction to Futures Trading Part 1. Infinity was founded in 1995, over 20 years ago, as an online futures brokerage firm, providing elite online trading software and data, best-of-class customer support, and continuous education. What if you could directly contact a personalized broker? What if your trading platform and charting platform is free? What if you had flexible day trade margins? What if you could trade multiple asset classes in one account? What if you had lower capital outlays? What if you could trade around the clock? Experience what if could do for you at Infinity Futures. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss, is not suitable for all investors. Past performance is not indicative of future results. In futures trading, depending on the capital in your account, traders can obtain low margin requirements than other types of securities. Because of this, traders have a greater level of leverage. The lower the margin, especially day trading margins, the higher the leverage and riskier the trade. Leverage could work for you as well as against you. It magnifies gains as well as magnifies losses. Let's talk about the trading ladder. The core of the trading ladder are the three columns in the middle, and we'll start with the easiest one, which is the price. You'll see in the middle of this E-mini S&P ladder that we have a series of prices where the middle is highlighted in a dark blue rectangle, and that represents where the last market price that was traded for this market. In this particular case, 25.72. Let's take a closer look. 25.72 was where the last buyer and the last seller agreed to do a deal. Well, in futures trading, there's not one guy doing a deal with another guy. It's electronically matched at the CME Globex marketplace. The bid quantity, this blue column here, represents contracts or trades on the buy side, people wanting to buy. In the ask column or offer column, it represents sell orders or people wanting to sell. And you could see from this particular view that you could see the number of bids, and we'll talk about what a bid is in a couple of seconds. 10 ticks deep. In other words, 10 price increments. Smallest price increment is a tick below, you'll see on the bid side, and 10 ticks above on the offer side. So the bid quantity is simply a representation of how many contracts are in the order book at the CME Group to buy an E-mini S&P at a certain price. Alternatively, in the pink column again, it's how many limit orders are in the order book that represents people selling at any given price 10 ticks above. Limit orders range from a single contract order to much larger orders, say 1 to 1,500. And we refer to the contract sizes as lot sizes. So a trader might initiate a 2-lot trade, a 1-lot trade, a 5-lot trade, a 10-lot trade. And these limit orders go into the order book on a first come, first serve basis. It doesn't matter if you're an institution, it doesn't matter if you're an individual trader, a speculator, a commercial hedger, whatever it is, when you send in an order, limit order to the exchange, it gets to the order book and is in line on a first come, first serve basis. So as an example, here at a price of 25.71 3/4, you'll see a number 316 on the bid side. That represents 316 contracts in line waiting to get filled at this price. Think about going to buy the new iPhone 7 or 8 or whatever it is, and you go to the Apple store and there's a long line. Well, you're not going to get filled in your order. You're not going to be able to buy the iPhone immediately. You're going to have to wait in line for everybody in front of you to get filled before you get filled or before you are able to buy your iPhone. So think of a limit order the same way. Alternatively, on the offer side here, you have a number 345. That's the number of limit orders to sell the market at 25.72 even. And you could see that the difference between the highest bid and the lowest offer is as tight as possible on this E-mini S&P market. It's one tick. That's the smallest increment. That suggests a liquid market, and the numbers being in the hundreds here on the limit order side also suggests a liquid market, which is good for transaction costs, and it's good with respect to the ability to get out of a position when you really have to. So just to recap this point, first in, first out, or FIFO. I know it's an accounting term. By the exchange definition, best price in the earliest time on the order book. That's who gets filled first. Bids and offers in the order book move around. They change. They're dynamic. So when you see these numbers 316, 463, 570, they all represent limit orders on the buy side, and then these numbers on the offer side, they change. They're dynamic. They get bigger, they get smaller. And the reason for that is just like in the iPhone line, new people will come to buy the phone and get in line behind you. That would represent the line getting bigger, or the number of limit orders getting bigger in the book. Alternatively, people might give up. I've been waiting in this line for 3 hours. I don't want to wait anymore. I'm leaving, and they leave the line. So there's subtraction. So the line shrinks. People cancel orders. And then another way for that number to change, of course, is if you're trading on the number and your order is filled. Somebody's order is filled. Somebody just signed the Visa card, the iPhone has been purchased, and they leave, and the next guy in line gets to step up to the desk. That's another way that these numbers change. So the quiz of the day is this: is it possible for a market to trade at the same price as your limit order and you do not get filled? Hint: at the Apple Store, they could close the store before you get to get in the store. So right now, this market here, this E-mini S&P market, is trading on the offer, and you can see 354 contracts in the book at this price. Now let's say that you're number 300, and this market trades, and you're trying to sell it, and you don't get to the front of the line. The price of the market changes. Let's say the price of the market goes down to 25.71 3/4. Well, your limit order is still sitting up here at 25.72. It didn't get to you. Alternatively, the market can't go past you. We can't trade at 25.72 1/4 if you have a limit order here at 72 even. It has to fill you first before it gets through you. So in that sense, you're blocking the market from going any higher. But that's just the nature of first in, first out on a limit order. Here's an example of a not so liquid market. This is the micro crude oil futures contract dated the March 2018 contract, and I'm doing this video in November 2017, so it's several months ahead. There's a wide bid-ask spread. It's not one tick like the E-mini S&P. There's low volume, not a lot of bids and offers. The contract date is way out in the future. So in this particular case, this wouldn't be a good market to day trade, because your entry will be so far away from the market that your transaction cost per unit value of the contract would be very high. Even with the micro crude December 2017, which would be tighter, it's probably still pretty thin. These kind of markets are best traded on a limit order basis only, and it's not really a day trade type of idea for these kind of markets. Order types. There's really only three basic types of orders. Okay, there's market orders, which are orders that get filled immediately at the best available price. There's limit orders, which are filled, we've been talking about limit orders, of course, but the definition of limit order is at your price or better. And then there's stop orders, which behave like a market order. And the stop order could be used for protection. It also could be used to enter the market, and we'll talk more about that in a second. And then lastly, you'll hear a thing called order cancels order, or OCOs. And these are simply instructions that modify orders when conditions are met, and they're typically automated, right? So you'd set up your trading platform for a series of if-then types of arrangements based on whatever your analysis is. Let's take a look at a market order first, and it's very simple. The definition is when you place a market order to buy or sell, it's going to look for the best available price. It's going to match you up with the best available buyer or seller to engage in a transaction that it could offer at the time. Okay, so let me expand this here. Oops. Let's do a better job of expanding it. All right, so in this particular case, you could see that if you are interested in buying this market, again, E-mini S&P, and the market's trading at 25.83 and a quarter, you have 423 contracts on the bid, and you have 385 contracts on the offer. And in this case, we're trading on the bid. In the last example, we're trading on the offer, but here we're trading on the bid. In other words, there's actual bids at the price that it just traded at. Now, if you wanted to buy at the market, it would give you the best available offer. And in this particular case, the best available offer is 25.83 and a half. There is no offers at 25. They're all at a half. So you would literally enter the order, and then you would be long +1 at 25.83 and a half. Alternatively, if you were to sell at the market with this configuration, right? So you did a sell order, the highest bid, you'd get the highest bid, right? The highest bid is right here. There's 423 of them. 25.83.25. So you would actually then get that price. In each of these examples with the liquid market, your transaction cost for that trade is 1 tick. It costs you a tick to get in, it costs you a tick to get out on most liquid market orders. Now, on thinner markets like we saw before, that's not the case. It could be several ticks between bids and offers, and then that would increase your transaction cost. Okay, limit orders. Again, we've gone over limit orders a lot, but it's you place an order at your price or better. You decide, hey, I want to buy at this price or better only. Don't give me a worse fill. Or hey, I want to sell at this price or better only. Don't give me a worse fill. Okay, and so let's take a look at where you could actually put a limit order in here and where you can't. So you could put a limit order to sell, as an example, anywhere above, including this 354, anywhere above the market. And when I say the market, I'm referring to this dark blue line, which represents where the last transaction occurred. In this particular case, anywhere you see one of these numbers, set of numbers, you could put a limit order. Alternatively, on the buy side, you could put a limit order on any of these numbers also, as long as it's part of the book. Now, if you were to put a limit order in at 25.72 even, well, you would get filled immediately, right? Because there's offers at that price, right? That's where the market's trading. You'd probably get filled immediately. Okay, so limit orders are typically thought of as below the market on the buy side, above the market on the offer side. And again, you're in line, so the more patient you are, the closer your contract gets to the front. Limit order to sell, I think we just went over that. It's just the opposite, where we would actually place orders above the market at whatever price you felt was a good idea, and you would wait, and that would be in there, and hopefully the market would come to you, and you would eventually get a fill. Stop orders behave like a market order. A stop order could be protective, or it could be used to enter the market. But when a stop order, when the market trades at the same price as your stop order, it will immediately look to provide you with the best available price. Let's expand this view a little bit. So buy stops are typically placed above the market. Sell stops are typically placed below the market. Okay, so in a protective stop idea, if you were long a contract at 25.72 even and you had a stop at 25.71 even, hey, maybe I'm wrong on my trade idea, and if this market goes against me 4 ticks, I just want to get out. I want to sell it. I'll take my $100 loss or $50 loss in this case, and try again later. So that would be an idea of sell stop down here, and then alternatively a buy stop up on the top would be the opposite if you were short. Okay. And again, typically they're one tick, right? You have a one tick in a tight market transaction cost. However, if the bid-ask spread is thicker or if the market's super fast, you could have more than one tick transaction cost, and that's called slippage. You could have slippage. You could have positive slippage or negative slippage. Usually it's negative slippage. Order cancels order refers to automating a trade. And it's providing the software with instructions on, and if then instructions on what to do if certain circumstances are realized. And there's simple brackets, there's multi-target brackets, there's breakout brackets, trailing stop, multi-target bracket with trailing stops, and there's a couple other ones. These are examples or categories of OCOs. Let's take a look at a simple bracket trade idea, and we'll look at a screen in a second, but basically you're establishing a long or short position and assigning or gluing a profit target and a stop loss to the position. In the case that a profit target is filled on the stop order, is automatically canceled. In the case that the stop order is filled first, the profit order is automatically canceled. So in this example here, we have a long position at 25.83 even, and that's represented here. You can see the dark blue market price here, along with a yellow flag that's highlight, I guess I'd call it, that says, hey, this is where we're long, and over here you can confirm that +1. Okay, we're long one contract. So the way this simple bracket is set up is we have a profit target 8 ticks above the entry price. Okay, in this particular case, it's 25.85 even. You can count up 8 ticks, and there's our profit target, and that's of course a limit order, right? It's graphically represented with green, meaning a limit order, and we want to sell one up there to take profit on this trade because we think our opinion is the market is going to go up. Alternatively, at the very same time, we automatically placed through the simple bracket technology a stop loss 6 ticks down at 25.8150, right? So we're willing to stay in the trade until we get down to 21.8550, and then we want to liquidate our long position and take our losses, right? So the idea here is all of these trades, all of these positions, this position and these legs of these orders are put in at the same time with a single click of the mouse. And then when one of the legs of this trade gets filled, the other one automatically cancels. That's the OCO part about it. So if we were able to get a profit up here at 25.85 even, then this 25.8150 stop would be canceled. Alternatively, if we got stopped out at 25.81.5, this profit target of 25.85 even would be canceled. In either event, we end up with a zero position. We're flat, in other words, as we would say, and there's nothing working. There would be no working orders here that we'd have to worry about to cancel manually or worry about a double fill. Multi-target bracket is really the same thing. Again, user-defined parameters, right? So in this particular case, this allows us to enter trades either on the long side or the short side in increments, in bigger lot sizes. So maybe 2 lots or 3 lots or 4 lots or 5 lots, however many you want to do. And then we could separate, bifurcate if you will, the profit targets for each of those contracts. So in this particular example, we have a 3-lot long position at a price of 25.83 even, and we've set up our OCO automatically ahead of time so that when this fill happens, it automatically puts 3 profit targets, separate profit targets for the trade. The first one is at 4 ticks above the entry price, the next one is at 6 ticks, and the third one is at 8 ticks. Alternatively, the stop is automatically set at 6 ticks below, and again, this is user defined, I just made this up, at 25.8150. So if the market were to go our way and we were to get the first fill at 25.84, in other words, we'd sell one at 25.84, then our 3-lot position, of course, would become a 2-lot position, right? Because we would have sold one of our long positions. And the stop down here, the 3-lot stop, would automatically be changed to a 2-lot stop because we only have a long 2 position anymore. So this would be a 2-lot stop. And then if the market keeps going our way, 84.50s get filled, we'd only have 1 contract left. The stop order would turn into a 1-lot, and ultimately we'd get the third profit at 25.85. Then the stop loss would be totally canceled, resulting in no positions and resulting in no orders out there dangling. Alternatively, you can get stopped out at any point during this process, and whatever remaining profit targets are left would also be canceled. Breakout bracket, this is kind of an unusual a trade technique, or OCO, but it allows traders to basically enter a position, either long position or short position, on stop orders. So you may think, for instance, that this market's been trading in a range and it's going to break out either on the upside or on the downside. You're not really sure which way it's going to be, but your technical analysis suggests that once a breakout occurs, it's going to move in a significant manner one way or the other. So in this particular case, you could see we have zero position. We've placed the automated breakout bracket such that we would enter on a stop. We'd get long on a stop at 25.8450, or we'd get short on a stop at 25.8150. So when the market does break out, we're either going to establish a long position up here or a short position down here. The other leg that isn't filled will automatically be canceled. That's breakout bracket. There's other types that we won't go into detail too much. I'd suggest everybody try the Infinity AT trading platform and experiment with these OCOs. But there's this typical standard trailing stop feature which allows traders to have their stop automatically move in sync with the market should their position be going in a profitable direction. And there's a multi-target trailing stop which you could apply to a multi-contract trade, which also trails as well as gets smaller as profit targets are met. And again, these are user defined. I would suggest everybody just try them out on the platform. Finally, the charting software provides all sorts of ways to analyze bid, offer, volume, trades that happen on the bid versus trades that happen on the volume. And we're going to talk a lot about that in part 2 of our presentation, which should be coming up in a week or so. Finally, I want to remind everybody that these are futures contracts we're talking about, where we trade on a exchange. And let's talk about the CME Group's exchange for a second. We're talking about a centralized exchange with efficient pricing and standard lot sizes. We're talking about a highly regulated market here in the U.S. for the CME Group as an example, where there's international confidence, domestic confidence, and a fairness and transparency reality when we trade these markets. Liquidity, a lot of these positions, a lot of these markets have a lot of liquidity. It's easy to get into and out of positions. Upfront investment costs could be a lot less for traders than in traditional types of security markets. And the technology, both the server side and the client side, are, in my opinion anyway, outstanding. Fills are quick, sending orders back and forth, modifying orders are exceptionally fast when they're done online, and it provides for a really efficient and positive user experience. Finally, some more resources for you to look at. InfinityFutures.com is our website. LiveTradingChallenge.com is another website, which is kind of a fun bi-monthly trading contest done in sim mode. Anybody can participate. It's a good way to get a good feel for how the platform works and how the markets work. YouTube.com/InfinityFutures provides a lot of different how-to videos and market videos and stuff that are recorded there, and you can go through them and search by a topic and stuff like that. And then Twitter.com/InfinityFutures, we often tweet out some trade ideas and some other interesting market information. A couple phone numbers there: 800-322-8559 and direct local 312-373-6220. My name is Jim Cagnina. I can be reached at trade@infinityfutures.com, and my Skype address is inf.jim.cagnina. Hope that helps. Have a great day. Thanks.